All right, shall we start?
Sure.
Great. Thank you so much, Lisa, for being here with us. So hi, everyone. This is the next MD4SG Colloquium. We'll be hearing from Dr. Lisa Cook from Michigan State University. So just for a brief introduction, Lisa is Professor of Economics and International Relations at Michigan State, and she earned a PhD in economics from University of California, Berkeley, with fields in macroeconomics and international economics. Previously, she was on the faculty of Harvard University Kennedy School of Government, and her research includes economic growth and development, innovation, and financial crisis. She's been publishing in various journals from American Economic Review, Journal of Economic Growth, and many others. And is an associate editor of the Journal of Economic Literature and the Journal of Economic History. So Dr. Cook will be talking today about mobile money and the COVID-19 crisis. So that's all I had. Thank you so much, Dr. Cook, for being here. Would you like to get started?
Yes. Thank you so much for having me. And welcome, everybody. This is a great audience, a great opportunity. And I look forward to talking to you about something that I work on sometimes in silence. I work on financial crises, but I also work on the economics of innovation. And this is where this paper topic and this talk came about. So the crisis that we see in front of us is unfolding at rapid speed. And I will use the term unprecedented, and it's almost become trite, but I'm using it again. This is really historic. We haven't seen the crisis unfolding this way, any crisis unfolding this way in US history and recorded US history. So if we're looking at the current dimensions of the crisis, of course, it is a health crisis first. It's a public health crisis first. And the data I consulted this morning from WHO said that in the US, we have 1.45 million cases of COVID-19 and 86,607 deaths. And this is really unusual for the US. We only know in our history the 1918 Spanish flu from that time that would come close to such a public health crisis. So let's talk a bit about the ensuing and resulting economic crisis. So more than 36 million people had filed unemployment insurance claims by yesterday, and that is just an enormous number in historical perspective. The unemployment rate is almost 25%, and that is from all of April. This is likely an understatement because this only includes data through the middle of April. So we certainly found that more people had filed unemployment claims even last week. Retail sales fell 16.7% in April. That is, again, a record for recorded history of keeping data on retail sales. One thing that Jerome Powell said on Wednesday, I believe it was earlier this week, and that struck me and struck a lot of people, was that 40% of households with an income of $40,000 or less had a job loss. So these are lower income households. And this is a really large number. This is not trivial whatsoever. It's a much smaller number. Typically 40% is very high. 12% of rental payments were delinquent in April relative to March. So we typically don't see numbers like this too. What all of this is adding up to is the possibility of a domino effect, a really big domino effect. All of these could lead to, any one of these could lead to a mass series of bankruptcies, but these together could really foreshadow a number of bankruptcies with respect to mortgage payments, bankruptcies that are, so defaults related to mortgage payments, defaults related to rental payments that ultimately are backed by a mortgage. So there are a lot of things that could go awry. Car payments, any kind of durable good that, say, is being paid off with a loan. So that's part of the dimension of the crisis. But let me give you some others. Another aspect of this crisis is that restaurant bookings have fallen. Of course, this is due to the crisis. You can see that the first coronavirus case was identified in the US on February 29th. And we have data from OpenTable, and this is showing percent change in OpenTable bookings. And as you can see, this is just plummeted. It's converging to zero, if not zero. And luckily, unlike the previous recession and previous recessions more generally, we have big data that we can use, big data that are being shared and that we can use to tell where we are at a particular moment. And I want to say just a bit about this because I think, as you all will appreciate, I know this is a multidisciplinary audience, but one I believe that's interested in measurement and empirical findings. It was a disaster at the White House sometimes not to have the data we needed when we needed it. And this is what typically happens in a crisis. We realize that we don't have the data in the increments we need and find enough increments. Before, it was mortgage payments because they were, mortgage payments were really sleepy and most people paid them, very few bankruptcies. And then 2008 comes along when you have these mortgage-backed securities and all kinds of exotic mortgages happening. So you actually needed much more data and in real time. So we have these data in real time. We have other types of data in real time too, including credit card payments. So this is from the JP Morgan Institute. And, this is Chase has several credit card products. So this is showing us what is happening to credit card spending by industry of employment. So we have in white, if you can see that, the government sector. Let's see, let me pick out one that's most prominent. The dark orange one is the professional sector, and there are a lot of others in between. But we typically did not have week by week data like this available when I was in the White House in 2011 and 2012. I was in the Obama White House at the Council of Economic Advisors, and I was typically working on the Euro crisis, and we really needed up-to-date data at that time. So this is, it's really great, and policy decisions can be better informed with real-time data. So I'm glad to see these data available now. Economists will get excited, and you're going to have to forgive us because these are data. But one thing that I realize, and that any policymaker has to realize, is that behind those data are numbers of people. They're actual people. There are people dying and they're suffering. This isn't just cool data. So I stress that to my students often. We can get excited about some things, but not in this morbid way that that some have. What I've learned from previous crises, I've learned that the response to a crisis should be equally quick. So if a crisis is unfolding in a very slow way, the economies are not connected, let's say they're often, and Mongolia is having a banking crisis. If Mongolia is having a banking crisis, there's probably one bank that has connection to an international bank. So we're not so worried about that. The IMF does not raise its hackles, and we don't get so concerned. However, if it is an economy that is quite intertwined with the rest of the world, like China, the US, banks in the Eurozone, then we get really, we get scared, and we should be scared, and we should act quickly. So The way in which this is unfolded has been really quick. As I was saying, there have been unprecedented job losses. Those have happened really quickly. There have been historic declines in demand. People are not buying things, as we saw from the open table reservations, as we saw from the credit card payments. These businesses are suffering as a result. And what you would want in such a crisis is an automatic stabilizer. And an automatic stabilizer is a policy that goes into place as soon as there's some negative change in GDP or in employment. I mean, the policy is set, there's a rule that is set, but it is set specifically for such rapid changes so that there doesn't have to be a policy discussion. There doesn't have to be a political price for people to pay to be able to implement these policies. So it may also be the case, if the tools don't exist, that there may have to be some innovation. So there may be tools that are invented, new tools that are invented. So during the global financial crisis in the period 2008, let's say, to 11, to encompass the, 2008 to 2012, if we're talking about the Euro crisis, this was something that the Federal Reserve did, and something that Dodd-Frank was passed to curtail, because many thought that the policymakers at the Federal Reserve were not elected, so this was not a way that they wanted crises managed. But the Federal Reserve was the one that could quickly respond. And there was all this debate in Congress. It was delaying a response. And this is what led to the swoosh. You've probably heard about the V-shaped recovery and a swoosh-shaped recovery. We had a swoosh-shaped recovery in 2008. The recession ended technically in December 2009, but we certainly had high unemployment much after that. So it was, and typically it's a case that if a financial crisis is the origin of an economic crisis, the recovery is fairly slow. We saw that in the Great Depression. So these tools may need to be invented. That's why you want automatic stabilizers. So there has been pre-negotiation about this, and the tools are already in place. So you want to take advantage of the time that you have out of crisis, because what we know is that a crisis is always coming. You want to take advantage of that time to get your ducks in a row, get these tools in place. So in case they aren't in place, what you want to do is that you would want to respond using existing infrastructure, leveraging existing infrastructure, and you also want to push the boundaries of that infrastructure that exists. So I was working on mobile money, the mobile money infrastructure in 2012. There was a group within the White House, and it was coordinated by Treasury. And the question was, can we get greater adoption of mobile money? It is very expensive for the Federal Reserve to process checks. So we were trying to figure out, with all the payments that Treasury has to make, say Social Security, Medicaid, Medicare, all of these payments, is there a way to speed them up, number one, and number two, make them paperless? And we were looking into that. These working groups always exist, typically exist in the White House, and this was the problem we were tasked with. So we were learning more and more about mobile money. The first concern was about cybersecurity. So at that time, there weren't too many safeguards with respect to money laundering, drug money. So this was one of the chief concerns at the White House at the time. But since 2012, a lot has evolved, and the Federal Reserve, or well, not just the Federal Reserve, but the federal infrastructure hasn't been a part of it. We didn't really have to invest in it. We had to make sure that that money was safe, but this has largely been investment by the payments industry, which is, I think one of the good things about the mobile money infrastructure that exists, there have been a lot of experiments with respect to mobile money since 2012, and we'll talk about that in just a moment. So as I was sitting back watching everything unfold, I started thinking about an opportunity to suggest use of the mobile money infrastructure now, and to try to push our digital infrastructure forward. I can't stress enough how important this is for the federal government. So I go into the federal government once every 3 years or so to leverage my skills, unfortunately, related to financial crises, especially related to financial crises. And one thing that happens if I'm there for the entire year, I lose about 10 years of higher ed knowledge. So things are moving really slowly, and the federal government, with respect to technology, as opposed to the outside, especially compared to institutions of higher learning. I remember going in 2011, and we had to use Windows 95, and we had to use Internet Explorer, and I was just having a meltdown every day. So I can't emphasize how much it weighs on many of us who are typically in institutions of higher learning to go into government and see how old the technology is. There's definitely a bias about spending on technology. If you remember the ACA rollout, that was precisely the problem. A good system would have cost a lot of money. It wound up costing us a lot of money. And instead, we decided to not spend as much as we should have. And we had technology from the mid-1990s that was being deployed for something that was happening in the mid-2010s. So anyway, this is a really important point with respect to implementation. It's going to come up again. So what about the CARES Act? So in the CARES Act, Congress allotted $1,200.
Can I ask a question?
Yeah, sure.
Is the bottleneck, like for Windows 95, for example, they just actually have computers so old that they cannot update the operating system?
That wasn't my impression. My impression is that they just didn't want to spend the money. And I think that there are several levels of spending the money. The first thing they needed to do was do cybersecurity checks. So, okay, so part of this is national security. I understand, I understand that. And they laid out an entire system based on Windows 95 or other vintages. And they just didn't want to start that process over again because it's such an elaborate process. And you can only use this on secure laptops and so on, or you can only use this on desktop. So it's fairly widespread, and things have to be uniform. Everybody had to use the same Microsoft suite. And I was thinking that's a risk in itself, right? Because viruses that affect Microsoft are just going to destroy the U.S. government, and we've had that. We've had a bug infect, the outer shells of probably every major agency. So it's a real risk, but they just didn't want to spend the money to replace it. The same is true at universities. My university balks when we first get estimates for changing our systems over. So this isn't unusual. But it's got to change. I mean, there are departments and units within the federal government that have a bit more latitude, and they can hire people at private sector wages. And when they do that, or they can collect private sector type fees, and they get in and they do, they do the job that is needed to get done. And I think that sometimes bureaucrats are afraid of the oversight of Congress, and Congress may not understand, given its supervisory role, its oversight role, it may not understand what type of investment is necessary. So it may have been Congress actually that didn't allow the spending to go forward for the ACA infrastructure, for the proper ACA infrastructure. And then when they saw what a disaster it was, then they were convinced that it should be replaced and there should be a different type of infrastructure. So yeah, that's largely how I understood it to work. It's risk aversion, and it is avoidance of large costs that they don't understand. Okay, so what was passed by Congress was a $1,200 direct payment to Americans, and I was advocating for $2,000 a month. But Congress decided to pump more money through the unemployment system to keep those who are unemployed afloat. That's absolutely fine, but you need both. So it's not that people are going to double dip. This would have been for 500. I mean, they're not going to double dip in a way that we have to worry about. We don't have to worry about massive fraud when there's, a 30%, almost 30% unemployment rate. I mean, that's the secondary consideration. So anyway, I would have liked more. I hope it will be more, but you certainly want them to be regular. The last thing you want people to be uncertain about is where their next payment is coming from, where their next check is coming from. How they're going to pay rent, how they're going to pay their mortgages, how they're going to pay for healthcare. So that's, I think that's really necessary to make people feel as though they can make rational decisions. So at first, checks were contemplated. And when I heard that checks were being contemplated, I broke out in a rash. We should not be using checks. I already know how much they cost. They cost a lot to process. And this whole working group that I was a part of at the White House was meant to try to eliminate those. So it emerged that direct deposit was also being considered because they were going to partner with the IRS. That made more sense. And checks. So this was with checks. So what I understood from the first estimates that I heard when I was talking to Treasury and talking to people on the Hill was that the checks may come in September, and that's completely unacceptable. If we heard this in March and this crisis is unfolding at such a rapid rate, this was going to be unacceptable. Businesses would have failed. People would have stopped paying their mortgages. They would have been in default. They would have stopped paying rent, and therefore their landlords would have been in default. So the whole system, the whole domino set would have started falling. So I found that unacceptable. And I would say that direct deposit is inferior to, and from a payment standpoint, it's inferior to mobile money payments because direct deposit is made in batches. Those payments are made in batches. So you have to program enough of them to go out at once. There's this, it follows a step function. Whereas mobile money can be continuous because it's a bank-to-bank transfer. It can be continuous. Direct deposit is not that. So I was hoping to avoid direct deposit if it were available. I mean, direct deposit, if it were available, it should be used, and that's the only thing that's available. But I thought that there was a faster way, and I'll say more about that in just a second. So what did I base this on? So I have done research on mobile money, and others have done research on mobile money. Why have I done research on mobile money? Where a lot of the places where I have studied or about which I've studied don't have properly functioning payment systems like the US or in Europe, or they have many people who are underbanked. And these are based on mobile phone systems, and you don't need a bank account for most of these places. Say in East Africa, it's really taken off. This is M-Pesa. If you know about M-Pesa, taken off in China and India, and it's taking off more in Europe than it is in the US, but the take-up has been slow in Europe, but there's a lot of heterogeneity across Europe, so that's not That's not a uniform statement. So when I looked at the countries that I work in or on, say Azerbaijan, Nigeria, Russia, it could certainly benefit from mobile money. Well, why? Well, Russia used to have the highest number of armored cars per capita when there was money moving around, cash moving around on the subway system, and it was in the billions of dollars of cash being moved around on the subway system every day. So certainly from a security standpoint, one could have benefited from having mobile money in Russia. In Nigeria, when I interviewed store owners, small shop owners, market people in Nigeria, again, a security issue, but also a health issue. So sometimes bills were so overused that they were, they weren't probably healthy to handle. And when you have a hyperinflationary scenario, which you had in Nigeria and in Russia, those bills get turned over and over and reused and reused and reused. So from Nigeria's standpoint, it would have been better to have mobile money than money in a sack or bills that were really, really dirty. In Azerbaijan, the same kind of security concerns that you would have seen in Russia, but there's a lot more movement in Azerbaijan too, given where it sits. And mobile money would have been, you can imagine that it would have been readily adopted. But it has some of the same problems of insecurity that you see in Russia. So you would want to, consumers would want to adopt mobile money in that situation too. So we see less adoption in the US, and that is somewhat baffling. And it'll be interesting to see what changes during this lockdown, because it is still a mystery why people don't use it. Now, I know that many of you are very young, so you don't understand this because you use Cash App and Venmo and everything else like I do, but many people don't. And it's still a mystery to us why there hasn't been take up. But I think that might change with more online payments during COVID-19, during this pandemic. I think that might actually change. So we'll see. But this was certainly the case before COVID showed up. Many people recognize its potential. As I said, this working group recognized its potential, and many financial institutions started working on it. And we'll say more about that in just a moment. So in the US, unlike in other places, you need a bank account. So this helps to allay the fears of the Federal Reserve and of other regulators that this isn't drug money, that this isn't supporting illegal activity, that it is all above board, that fraud isn't being committed. So, so bank accounts help to produce the kind of paper trail that you need. So that's why it is needed in the US and not necessarily in other places. So my focus in the proposal was on the underbanked. So those are people who have at least one bank account, but what we see in surveys is that they use other financial products and ones that are punitive, like payday lenders or check cashing options. So what, if they use those, this is a revealed preference argument for those who are economists. If you use something that rather than using the alternative, it suggests that you prefer that thing that you actually used. So what we are inferring from their behavior is that they preferred, for some reason, using check cashing or a check cashing outlet or payday lender. So this is about 16 to 17% of Americans, depending on which survey you read. That's actually a lot of people. So these were the people I was targeting. For the other part, for other people who were unbanked, that's about 6 to 7% of the population, again, depending on which survey you use. But Treasury already has a product for them, and it is a debit card that they send to people if they don't have a bank account. So I was thinking that this is the time to really focus on the underbanked and get mobile money moving forward. So one should be hopeful about mobile money apps because the mobile money infrastructure is there, it's been built out. 80% of Americans have smartphones. And the highest concentration of these smartphones is among the young. So 96%. So there's not a one-to-one mapping. I mean, just because you have a smartphone doesn't mean that you will readily embrace mobile payments, but you have the capacity to. And what we see is that most of the payments are made among fairly young people. Minorities also use smartphones at a higher rate, and they use cell phones for broadband at home more than whites. So the folks that you'd want to target who might be more vulnerable during a financial crisis actually are using this technology more than others. So what we also know is that mobile purchases are increasing. So every year we see mobile apps being used more and more, say Apple Pay, Venmo, PayPal. Those are being used more and more. Those are being adopted more and more. And this was about 35% or so of smartphone users made mobile purchases in 2019, and that was anticipated to grow. And again, I think that the serious penetration is among young people. So in my mind, for the purposes we were looking at, the best solution to me is a bank-to-bank transfer, a mobile app that allows a bank-to-bank transfer. Because what you don't want is a third party intervening that does not have the protections that a bank has. So banks have FDIC protection. So this would be like Zelle. So there are 766 financial institutions that are part of the Zelle network, but that is a minimum, that's a floor. That would be a lower bound because Zelle has agreements with MasterCard and Visa to provide payments in case they're not affiliated with Zelle. So this includes Bank of America, it includes Wells Fargo, it includes JP Morgan Chase, but it also includes a lot of community banks. So this is what makes it attractive in my view. Now, I said community banks, excuse me, and that's because of their reach, their geographic reach. If there's a problem with a payment, you might be able to walk into a branch. So that's why I'm touting something like Zelle, if not Zelle itself, because of the broad network that has been tested and that is available. So these are bank-to-bank transfers. So we have also, there are other solutions, ones that I've already mentioned, PayPal, Venmo, and Cash App. So they have a particular problem. They use a third-party digital wallet that is not FDIC insured. So when you make a payment, it doesn't go directly, it goes to a third party where it sits. And if you're already having payment problems, let's say Square and PayPal are having problems because that's what a lot of small businesses use. Etsy and eBay use PayPal quite a bit. People are not buying things on Etsy and eBay as they were before. There's been a lot of substitution, that's certainly true, but they were kind of in trouble at the beginning of the crisis. And I don't know that that's been resolved yet, but that would raise a caution flag for using any of these. The FDIC insurance is something that makes everybody feel better. So you have, this is the disadvantage with these payment applications, but for Zelle, because it's a bank-to-bank transfer and because it's automatic, you have problems related to fraud. So one thing, so I've been watching this experiment over the 8 years since I've been out of the Obama administration, and I started using all of these platforms just to see how they worked. And if they were available, I didn't think Cash App was around then. But anyway, I adopted them as soon as they came online. And what I noticed is that the warnings related to Zelle became even more explicit. And this is one way, again, to protect the consumer, became even more explicit. Are you sending this to a person that you know? So that's both for security, national security purposes and for fraud purposes. But only make payments to people that you know, and this is a way to try to prevent fraud. So the messages have become more and more sophisticated. There's a cap on how much you have to send or you can send. I think it's $1,000 a day for Zelle. So that's another way to prevent fraud. So they've been experimenting with this for the past 8 years. So it's been interesting to watch. So all of them have their advantages and disadvantages. These, though, present a problem for the financial system that may undermine the safety and soundness of the financial system because they're not FDIC insured. So when I am talking about my proposal, I'm typically talking about Zelle. Okay, so how would it work? Okay, so we have our smartphones, we have the applications that we can use. So how do they get the money to individuals? Well, what they would do, and what I was proposing, was that Treasury get IRS and the Social Security Administration data. They already have that, so it's not like we're hiring a team of RAs to go get these data, download these data. They're already there, but they would need to be merged with cell phone data from FEMA and the FCC. So why FEMA and the FCC? Well, everybody got an emergency alert in October 2018 from the president saying this is a test of the emergency wireless system, right? So given that we already have this infrastructure, all we need to do is to merge these data sets. So match cell phone numbers to the IRS and Social Security Administration data. And then I was proposing that a website be set up with a 4-question survey, very, very simple, asking for your name. So it could be a 3-question survey. The 3 core questions are name, social security number, and cell phone number to get a good match. To increase the match rate, you might want to include an email address because, as you probably know, to sign up for these services, people either use their cell phone number or they use their email address, right? So you want to have both to be able to get a good match. Now, this isn't pie in the sky. Canada did this. Canada got a website up and running in a week, and then people were being paid within 24 to 48 hours. So we know it can work. It even had a little virtual assistant attached to it. So when I was getting pushback about this, I was saying, well, Canada could do it. Why couldn't we do it? So anyway, the website was supposed to be for those people who may have changed cell phone numbers or other people who might fall through the cracks. But one big thing that I was concerned about that everybody seemed not to be taking into account, policymakers seem to not be taking into account, is that people are not necessarily where they typically are, right? Because they may have sheltered in place some other place. A lot of people went to their parents' houses, or they went to a friend's house, or they went to a second home. So if they're waiting on a check, which was the way that was being advertised the most, if they're waiting on a check, they may not get that check in time. And certainly nobody's going to go out into, COVID land to go home and get a check from a mailbox, right? So anyway, this was one of the big reasons that I was putting it forward too. And some of the people in the population that moves a lot, say students, have the highest penetration of cell phone use, of smartphone use in particular. So that's another reason that I was putting forward this mobile money suggestion. So I talked to people in the Treasury, talk to people on the Hill, talk to financial institutions to see if this were actually viable. And across the board, people, now they gave me a lot of questions, and also the Federal Reserve. I talked to the Federal Reserve about this. The people I talked to were initially skeptical because they thought that direct deposit was a gold standard. But again, in the world of payments, if you study payments, like a number of the people I talked to did, they knew that you could get, you had to pay direct deposit in batches. So if you really were trying to get money to people faster, this would be a good alternative. So there was support from the technical people, the people who would implement this on both sides, who would implement, and from the regulators if this could be worked out. Now, it would require the Federal Reserve's involvement along with the involvement of the Comptroller of the Currency, FDIC, and Treasury. So those people needed to be in conversation. Now, they've already had these conversations because of the way, say, Zelle and MasterCard have been interacting. They've already had some of these conversations. The thing you want to avoid is starting these conversations anew in the middle of a crisis. You want that to already be in place. It's largely already in place. Why don't you create something that has a low marginal cost of implementation, low sunk cost of implementation, and make that work? So that's why I was putting it forward.
Sorry, I think we have a question from Elizabeth.
Yes. Sure. Mm-hmm.
Elizabeth, I see you raised your hand. Would you like?
Yes. Hi there, Dr. Cook. Thank you for being available. So going back to your reference to the scale of debt issued by countries, my question is Lebanon, that just recently announced that they're going to be defaulting on 1.2 billion, what the impact would be on the scale. And also with regard to the Federal Reserve secondary market corporate credit facility that began purchasing ETFs and corporate bonds.
Right.
What would be the impact on the secondary market for premiums on the bonds after they're issued? Because there's only 24 primary dealers, so far more investment managers. So the impact there, and then also for individuals receiving social services, where them receiving money could possibly increase their asset for their ability to continue to receive social services. So could that negatively impact based on the stimulus money received? Sorry.
Okay, so let's start with the Lebanon's declaration. Lebanon is possibly not alone. And what we see is that this typically affects small open economies first. Think about the Euro crisis. So it affected Greece, Ireland, Portugal, and Spain, and you might count Italy the most, right? So the Southern European countries, but because they're so open and because they do so much international trade, this things can evolve much more quickly in those economies. The urgency can be a lot greater. So you were saying that, so yeah, they may be some of the first to declare, effectively bankruptcy, or to not repay their, declare that they're not going to repay their loans, their international loans. Now, you were saying that what do I expect to happen with respect to the secondary market? To tell you the truth, I don't know. And let me tell you why I don't know. And a lot more people should say they don't know, because it is still the case that the market, I do not think, has registered how slowly Congress is willing to move, slowly the Congress administration is willing to move. And secondly, I think a number of them think that they're going to get a payday, just like the payday bailout, just like happened in previous crises, that the folks who were invested in the stock market or who were invested in Latin American debt, for example, this is what happened, and this is how investors are conditioned to think. And they've already gotten a bailout. They got a bailout with respect to the tax cuts last year. So I honestly don't know what's going to happen. And given that that the Federal Reserve announced that it may not update its June forecast, I have never in my career have I heard the Federal Reserve say that it would not update its forecast. It didn't say it during the last crisis. It didn't say it during previous financial crises. So this is serious, because that means that there's so much uncertainty that creating an estimate with such a wide confidence interval is meaningless. It's meaningless. And I was there. I've had to do some budget forecasting, and I had to say, sorry guys, not producing an estimate, because it is meaningless. So I don't know the answer to your question. It just depends on behavior that sometimes seems to me and seems to other people to be irrational. And that irrational behavior is really on display when the stock market is going in one direction and unemployment numbers keep going up, right? So we see this kind of cognitive dissonance. So I honestly don't know, but I think it's something that we have to keep watching. And I know the Federal Reserve is watching. The Federal Reserve has to watch so many more markets than it does in regular times because it's exposing itself to different types of risk. So it'll be interesting to watch. Okay, so with respect to my mobile money proposal, now some people thought that I was being much too optimistic about this mobile money proposal, that the government moves really slowly. It didn't take any action in the 8 years since I was there. So why was I so optimistic? Well, I got partly what I wanted. So there has never been the type of website that I was proposing up at the irs.gov website, and there is. So that's a good thing. I don't think that, and I haven't heard that the processing times are like that of Canada's, 24 to 48 hours. I would have heard that. I know that's not the case, right? That just can't be the case. So I hope that there is a plan to keep track of how quickly this is going and to make it as fast as it can be. And hopefully one day, when we're not in a crisis, we actually leverage the mobile money infrastructure. So it's a part win, but I'm willing to take it. Having been at Treasury in the White House before, I am willing to take a partial solution. There's nothing as frustrating as policy is if you're an economist. At the same time, you've got to be very pragmatic. You've got to do whatever is going to get money to people the fastest. May not be the first best solution, but it is a solution that can work. So why don't I stop there, and I'll take any questions that people have.
Thank you so much, Dr. Cook. That was really amazing. So let's open up for questions. If anyone would like to ask, feel free to ask directly, or you can also write in the chat and I can read loud your question. And I can start with a question too. I was wondering regarding the FDIC insured options versus the non-insured ones. I know there's been a lot of work in the non-insured ones in like Venmo and PayPal to also have this like more security measures in which they would ask people, do you trust this person, or like double check with their phone number, like adding the last 4 digits of the phone numbers. And it has seemed, at least in like the people that I know, so I don't have a large scale sense, but that people would trust the systems, especially that the more transparency is in them, in the ones that are more open source, like TransferWise and things like that. So I'm wondering, do you have this sense of how do people trust these different systems?
I do, and you bring up a good point. I think that people trust them, and they shouldn't as much as they do, right? They don't know that there's a third-party digital wallet, and they don't know that it's FDIC insured. But what they do know is they recognize that there's a difference between the speed of payments with Zelle versus the speed of payments with Venmo and PayPal, especially with PayPal. They can be really slow. Yeah. So I think people recognize the differences, but they don't recognize the important difference, the one related to FDIC coverage and the existence of this third party digital wallet. So I am grateful that people trust these systems a lot, right? And that's a good thing for adoption. But I think they have too much faith in them from that perspective because they're not asking about FDIC coverage. I mean, that's great for fraud. That's great for mitigating fraud, asking whether you know the person, but it's not good for the safety and soundness of the financial system. And they couldn't work those out really quickly. So PayPal wasn't able to participate, but PayPal was able to participate in the PPP program as a non-bank lender. So that meant that the bank regulators, the Comptroller of the Currency, the FDIC, and the Federal Reserve must have been in negotiations with Treasury to make sure that that happened. But that's a large risk. Non-bank providers being allowed in this program. What if all of the loans, if there's default on all the loans, and they're not used to servicing people in this way? It could be a large risk to the financial system.
Dr. Cook, one more question. If stimulus payments are made using the banking, the mobile apps, does this possibly increase the risk of individuals that are the most marginalized receiving social services, the risk of losing those benefits? Because each year, a couple times a year, some of these people, everyone that I know receiving social services, have to do verification on their assets and how much money they have in their bank accounts. They lose their healthcare benefits or food stamps or supplementals.
So, what I understand is that at least this was the plan, to make them exempt from this. You want these to be additive. You don't want them to be substitutes. So from what I understand is that, and I know this is the case with SNAP benefits, that those are additive, that they're not being taken away, and they're supposed to be additive for the others as well. So I don't think they're in jeopardy, but because these things are being rolled out so quickly, and because there isn't guidance given that is often clear and speedy, you might have a problem that arises. I mean, look what's happening with the unemployment insurance claims, right? These systems that the folks from Hidden Figures probably worked on because they're in COBOL, right? And they're not servicing a 21st century clientele. They're servicing a 1950s or 1960s clientele, right? So there are still snags in the system. So I completely get that. But that's why I would advocate our upgrading digitally outside of a crisis event, when we have time to think about it, have time to plan it, have time to test it, have time to roll it out. And these are only going to get faster, by the way, because financial payments are getting faster. Yes, I'm saying that financial payments are faster. Let's leverage that. But financial payments are getting faster. Therefore, we have to do things more quickly. This can create more crises. So I get that. You have to match the problem with the solution.
We have a question from the YouTube live stream as well. And just a reminder for whoever is watching there too, that you can add your questions in the text and we'll read them here as well. So the question is, why is the US so behind when it comes to going mobile? Shouldn't it be more advanced considering our financial status and overall status in the world?
We've been behind for a long time. We have really been behind for a long time. So when I lived in France in the 80s, I could purchase groceries with my credit card. And that was unheard of in the US, absolutely unheard of. They were much farther ahead. When I was in South Africa in the early 2000s, it was much farther ahead. It was farther ahead than Europe was with respect to banking. So I think what has happened is that mobile money has been a substitute for well-functioning financial systems, for well-functioning banking systems. So if you have a well-functioning banking system, and this is what I find in Africa, so I typically focus on Nigeria, and Nigeria has the second largest banking system on the continent after South Africa. And in South Africa and Nigeria, you don't have this uptake in mobile money like you have in Tanzania, Kenya, and East Africa. And that's because they had a poorly functioning financial system. Very high cost to open a bank account, open a savings account, to do any kind of financial transaction. So these seem to be complements. So I'm not so surprised by it, but because there are many people who use these, especially, I'm just guessing about everybody on here, or many people on here, because young people use them so much, use these mobile apps so much, we would embrace them. And I think that there's just a lot of opportunity there. And I think a lot of other people see it too. And an opportunity to minimize costs associated with cashing checks. This same working group was looking at getting rid of the penny. It costs more to make the penny than the penny is worth, right? So Canada's already gotten rid of the penny, right? I know I keep going back to Canada, but I'm just saying, there's some examples of smart decisions that are made based on the evidence. And I think there's some models that we can follow. So I really hope that there's greater adoption. It's going to be interesting to see once we get out of the COVID crisis, what happens.
We have a question in the chat here too, and thank you for that answer. I think that's super interesting to think of them as complements too. So a question from Funke Anderonmu. Thank you, Dr. Cook, for your presentation. In terms of people who may not have access to cell phones or reliable broadband to receive mobile money, does your proposal include any solutions for them?
Many of the mobile money apps don't require a smartphone, and most of the cell phones have enough technology to be able to capture these. And that's certainly true in emerging markets and developing countries. So I would rely on those for the most marginalized. But again, I think for the payments, I think Treasury has a solution for those who don't have bank accounts and who are the most marginalized. And that's that debit card that can be reloaded. If there's an additional payment, it could be reloaded, but that's another way around that problem.
Oh, and the question from Anne-Margaret Tutu on the chat as well. Do you think providing every American with a low-cost smartphone would make it more feasible to scale this out? Are there any initiatives doing this?
That's a good question. I don't know of any initiatives to do that. I read about initiatives to do that in the countries I was looking at, but not here, not on a large scale. I haven't heard of that. I think that the bigger movement, and this is because I study finance more than I study telecommunications, the bigger movement is to try to get people a low-cost bank account. That, and one problem with bank accounts for poorer people, for people with less income, is maintenance costs. And banks don't like to open them because they're typically high transaction. If you're lower income, your marginal propensity to consume is going to be higher, so you're going to make more withdrawals. You're going to make payments more often. You might make 2 or 3 credit card payments per cycle rather than just one. So the bigger movement I see is trying to get next to free banking accounts. And in fact, some people wanted me to add that to my proposal, that for those who don't have smartphones or good enough smartphones, that they get a chance to use, say, credit union accounts or accounts at banks that were free for this one time, and the federal government would actually pay for those accounts.
Thank you. And the question from Judy Wawira Gichoya, I hope I pronounced right. Do you think the FDIC is critical for the US as a safety network versus in places like Kenya where such protections may not really exist, yet there is a very good uptake of M-Pesa?
Yes. I really think that the FDIC is critical. We're accustomed to having it. And I think that if it were taken away, that is a privilege that is taken away, a benefit of having the kind of financial system that we have, this public good that we share. So I don't think that banks would allow a system to arise that only depended on telecommunication systems. And in fact, in the places that I was telling you about in South Africa and in Nigeria, another reason you don't see such take up is because the banks are a strong lobby and they wanted a piece of the action. So there are political economy reasons for there being lack of take up. And one might see that here too, but I think it's also because we're much more accustomed to the FDIC watching these transactions very closely and our deposits being protected and our financial system being protected.
Thank you. That makes sense. And are there any other questions from the audience? If not, I had another question. Also, so I know there's some countries, especially in Europe, who were looking into getting rid of cash, for example, and moving everything into either like banking institutions or mobile money as well. What do you think the effect of that could be? Like, I know a lot of people have concerns into, cash being efficient in some ways, as you mentioned, but they're concerned as being like some of their activity being monitored or surveilled, privacy concerns related to that as well.
So I certainly understand those concerns. Those have to be weighed against the market women who would prefer to have a transaction done through a cell phone than to have stacks of money that they carry around and they might get robbed for. So I think that there's just a trade-off, a local trade-off that has to happen, and that has to be weighed. Now, COVID-19 has introduced a whole different scenario because people have not been using cash. I don't know about you, but for the most part, the businesses that I frequent, and so I don't frequently go there, but I frequented in the past, they tell me that they are not receiving cash payments. People are very reluctant to touch cash. So I think we might be seeing a mobile money revolution that's coming from a completely different place, that's coming from a public health argument rather than one that relates to getting people money fast. So again, it'll be interesting to see what happens post COVID-19 with respect to adoption of mobile money.
Thank you. That makes sense. Yeah.
Good.
I can ask the final question. So it seems that a lot of the issues that you're mentioning here are changes that we would like to see at the government level or things that we'd like to be adopted at the government level. Do you have a specific call to action for us, especially those of us on this call? I think many of us are sort of junior researchers in the economics and computation space. Do you have specific things that you think we should be thinking about or advocating for both in the short and the long term to see these changes?
Yes, I think so. I think, I think you guys are already doing your job because you've already adopted these mechanisms. You're using Apple Pay. You're using the Starbucks app. You're using these technologies. And I would just say that from an advocacy standpoint, to support the further distribution of these types of payment mechanisms, the further use of these types of payments, the greater penetration of these. And one thing that you might argue, and this is one thing that I argued, not only would mobile money be received quickly from the federal government, it could go on to the next business very quickly. So you're both saving the individual and the individual household's consumption while preserving a small business, right? So you're paying for takeout at the same time in a really fast way. You're paying for Starbucks or you're paying Uber Eats or Grubhub or whomever very quickly. So that's one more reason to do it. So that's one point of advocacy. I would say, it's been really hard to study mobile money. You don't see a publication from me in a top journal related to mobile money. Actually, not even from me, not just from me, but from other people. So I would say that we would want to try to get not only more adoption, but data available related to that adoption, so that you guys can work on it in a way that older generations of scholars have not been able to. So one day I look forward to working on this more and better, but we just haven't had the data.
So actually, quick follow-up question. I think that one day might possibly be sooner, just in part because, in computer science, there's a lot of different types of venues, and I think we tend to get very excited about data. So it doesn't have to have been like around for a long time. I think
Right.
that's sort of how I understand economics. So in that sense, are there companies or organizations that you suggest that we look at or try to kind of build a bridge with, especially for those of us who are in computer science, to see whether we can kind of help jumpstart that process?
I would definitely say MasterCard, Visa, and Zelle. I mean, I I would say if we had been outside this crisis, I would have added PayPal, but because PayPal and Square, but because they're in trouble, I think it's going to be a lot harder to get data from them, even in the short run and the medium run, because you can. And this actually happened in the last financial crisis. The folks that I was trying to get data from were actually in trouble, and they signaled that they were in trouble by not giving me the data, right? So it actually it helped me because it was helped markets to clear. It was scary. But I would say Zelle, MasterCard, and Visa. JP Morgan Chase actually has an institute, and I think that they would probably be more willing to share their credit card data, the credit card data that I showed you. So I think that they have more access. They have access to Zelle as one of the affiliates. So I think I would actually start there. And there are a number of former policymakers who are at the JP Morgan Chase Institute, so they would get what you were doing and get what you're trying to measure.
Thank you. Very good.
Okay, great. Any
Great.
more questions?
Thank you for this. Are there any other questions? All right. If not, thank you so much, Dr. Cook. Again, that was a wonderful presentation. I think it gave us a lot to think about, both what we can do with thinking about how to integrate this technology with what we need in terms of crisis, as well as, that we need to think about is not when the crisis comes, but to think about it in times of more peace.
Okay, yes, and peacetime, that's right. Well, thank you all so much for having me, and good luck with your research whenever it takes place.
Thank you so much. And thank you everyone
Thank
for
you.
participating.
Thanks.
Thank you. Bye-bye.
Thank you.
Thank you.
Thank you.